Turning to this week's best in class, the Loomis Sayles bond fund is up more than 17% year to date, outperforming 91% of its peers. We're joined from Boston by one of the fund's managers, Kathleen Gaffney, to discuss where she sees opportunities in the fixed income market. And Kathleen, nice to talk with you this morning.
Hi, Betty.
Okay, well, last fall, as you know, with the crisis unfolding, I mean, bonds were getting pummeled at that time. And I think I remember you being quoted as saying that that was an opportunity in a lifetime, an opportunity you hadn't seen in your lifetime or for many others. Things have recovered since then. Cheap back then. Are they still cheap now or what?
They have come way back, and it's surprising. We're back to where we were pre-Lehman, and I would say that there still is value, even with the significant gains that we've seen so far.
Okay, where is the value now? You've got to be a whole lot more of a sleuth these days, right?
You do. You have to work a lot harder for it. The value is still there with the spreads relative to treasuries. If you look back historically, we're still at very wide levels. We were at wide levels previous to Lehman. The challenge is that the recovery is likely to be very weak, so we're not likely to see a lot of momentum and spread narrowing this year, but that yield advantage, that ability to collect the coupon, is very meaningful and will help continue to drive returns this year.
But Kathleen, I mean, could you be more specific on where, though, in the corporate bond markets you see the most value? I mean, I think I remember Dan Fuss, your co-manager there, talking about like BBB bonds, for instance, being a good value at that time. I mean, what about now?
Yes, and BBBs are probably one of the cheapest parts of the market still right now. In fact, I describe them as having kind of an orphan status because a lot of investment-grade managers don't want to own downgrade candidates, so those spreads remain wide. And the cheaper areas are where there still is a lot of uncertainty about the economy. So cyclical credits in the paper, steel, chemical area are wide, and you want to look for the companies that have strong balance sheets and good cash flow that can survive through this cycle, the number ones and number twos in their market. You've also got sectors that are consumer oriented, like the retailers, and they're cheap as well. So lots of opportunity, but you have to be careful and look at the balance sheets very closely.
Now, you don't have a whole lot in treasuries. I don't think you have much in treasuries at all, and you know, that might have hurt you last year when things were going down the toilet. But you still don't have a whole lot of treasuries now. I mean, why not?
No, we did have some, and those are our reserves. We spent them buying those cheap bonds back in the fall. And as we look longer term, particularly with all the stimulus, while we don't see inflation in the near term, it's percolating out there, and we're going to be facing a long period of rising interest rates. And one sector that you want to really stick away from in a rising rate environment is treasuries.
Okay, Kathleen, thanks so much for joining us. Great to talk with you. Kathleen Gaffney of Loomis Sayles Bond Fund.